Hey there, welcome to our channel. Today, we'll discuss what is the credit debt swap. If you're a college student or just someone who's interested in finance, you might have heard this term being thrown around. But what does it actually mean? Let's find out. First, let's start with some basics. Credit debt is essentially the amount of money that you owe to a lender or a bank. This can be in the form of a credit card balance, a mortgage, a personal loan, or any other type of debt. Now, let's say you're having trouble paying off your debt, and you're worried about defaulting on your loans. This is where a credit debt swap comes into play. A credit debt swap is a financial agreement between two parties, where one party agrees to take over the debt of the other party in exchange for some other asset or financial instrument. This can be done for a variety of reasons, such as reducing the risk of default, improving credit ratings, or just simply restructuring the debt. For example, let's say you owe $10,000 on your credit card, and you're having trouble making the minimum payments. You could enter into a credit debt swap agreement with a bank, where the bank agrees to take over your credit card debt in exchange for some other asset, such as stocks, bonds, or even cash. The bank will then pay off your credit card debt, and you'll be free from that debt. In return, you'll have to give the bank the agreed-upon asset. But why would a bank want to do this? Well, the bank is essentially taking on your debt because they believe that they can make a profit from it in the future. They might be able to negotiate a lower interest rate on your debt, or they might be able to sell your debt to another investor for a higher price than they paid for it. Either way, the bank is taking a calculated risk by taking on your debt. Now, you might be wondering if credit debt swaps are a good idea. The answer is, it depends. Credit debt swaps can be a useful tool for reducing debt and improving credit ratings, but they can also be risky if not done properly. It's important to do your research and consult with a financial advisor before entering into a credit debt swap agreement. In conclusion, a credit debt swap is a financial agreement between two parties where one party agrees to take over the debt of the other party in exchange for some other asset or financial instrument. It can be a useful tool for reducing debt and improving credit ratings, but it can also be risky if not done properly. We hope this video helped you understand the basics of credit debt swaps. If you have any questions or comments, feel free to leave them below. Thanks for watching. Hope see you in the next video. Please subscribe to our channel.